there, welcome back to Concierge CPA. I am Juliet. In this video, we are diving into a topic that might seem a bit intimidating at first. Liabilities. Now, I know what you might be thinking. Liabilities, aren't those the bad things we're supposed to avoid in business? What if I tell you liabilities are not only essential for business growth, but they can also be the key to unlocking your financial potential? Imagine you're a filmmaker with a vision for a groundbreaking movie. You have the perfect script, a talented cast lined up, and a shot at premiering at major international film festivals. However, to bring this vision to life, you need advanced equipment, a professional crew, and perhaps a stunning location that fits your story. These resources, essential for your masterpiece, can be accessed through liabilities, loans, credits, and other financial commitments, like a skilled director using resources to craft a cinematic masterpiece. Businesses use liabilities to turn their visionary projects into reality. Far from being mere financial burdens, liabilities are strategic tools that businesses can leverage for growth, expansion, and operational success. Okay, now that we got that misconception out of the way, what are liabilities? In accounting, liabilities represent what a company owes. These are the debts and financial obligations incurred during business operations that must be settled over time through the transfer of economic benefits, including cash, goods, or services. The official definition of liabilities as issued by the FASB in the Statement of Financial Accounting Concepts number 8 is: a liability is a present obligation of an entity to transfer an economic benefit. The concept also states a liability has the following two essential characteristics. It is a present obligation, and the obligation requires an entity to transfer or otherwise provide economic benefits to others. Liabilities is one of the three pillars of the balance sheet and the accounting equation. Assets equals liabilities plus owner's equity. They are listed on the right side and are divided into two main categories: current or long-term. Current liabilities are financial obligations that a company is expected to settle within one fiscal year. They are essential for managing the day-to-day operations and are closely tied to a company's operating cycle. Long-term liabilities are the obligations that are due after more than 1 year. These are vital for long-term planning and large-scale investments. Some common examples of current liabilities are accounts payables, accrued expenses, and short-term debt. Let's look at each a little bit farther. Accounts payables includes money owed to suppliers or vendors for products or services that the company has received but not yet paid. This is a typical operational liability arising from normal business transactions. Accrued expenses are incurred expenses that have not been paid. This category can include salaries for employees, interest payables on loans, and utilities that have been used but not yet billed. Wait, what is the difference between accounts payables and accrued expenses? The key difference lies in the documentation and the timing. Accounts payable always involve an invoice received from a vendor or supplier. Accrued expenses, however, are about recognizing costs that have been incurred but not yet billed. This could be things like salaries that employees have earned but haven't been paid yet, or interest that has been accumulating on a loan but isn't due until later. The key point about accrued expenses is that they are recognized under the accrual basis of accounting, which means they are recorded when they are incurred, not when they are paid. It's like noting down what you owe, a payment for a service that has been completed but not yet billed. Another common current liability is short-term debt. This includes any borrowing that must be repaid within a year, such as lines of credit or short-term bank loans. These are often used for immediate financial needs. Moving on to long-term liabilities. Some common examples of long-term liabilities are long-term loans and bonds payable. Long-term loans are business loans that have a repayment period over 1 year. These are often used for substantial investments in the company's future. Bonds payable is a form of financing that involves the company borrowing from investors and agreeing to repay with interest by a set date. It's a common method used by businesses for raising large amounts of capital. Both long-term loans and bonds are crucial financial instruments used by businesses to manage their capital needs. fund expansions, and stabilize their financial structures over extended periods. Here's a real-life example. Imagine a small independent brewery that wants to increase its production capacity to meet its rising demand. The company decides to purchase new brewing equipment and expand its distribution network. Instead of using all its cash reserves, which may be needed for other operational expenses like ingredients and salaries, the brewery takes out a long-term loan or issues bonds. This debt is categorized under long-term liabilities. It allows the brewery to scale up production and grow its market presence without compromising its operational stability. There is one other liability we should go over that could be either current or long-term. This is deferred revenue. Yes, revenue could start out as a liability for a business. Deferred revenue is money received by a company for goods or services which have not yet been delivered or completed. Therefore, it is a liability because it represents an obligation to deliver products or perform services in the future. This liability becomes revenue when the obligation is satisfied and the revenue then becomes earned. Revenue accounting could be very complex, and for that reason, I plan on creating an entire playlist on this accounting topic and standard. So if you're interested, make sure to hit that subscribe button and click on that notification bell so you can be notified as soon as the videos are up. But for now, here is a quick example. I'll use the example of a prepaid subscription. Imagine a software company receives a payment for a year-long subscription in advance. Until the software services are rendered monthly, the advance payment remains recorded as deferred revenue. So again, when someone buys a year-long subscription in advance for the software company, it's kind of like getting paid up front for a job they'll do over the next year. When the company gets this payment, it doesn't count it all as income right away. Instead, it treats it as deferred revenue, a liability. Think of it as the company saying, thanks for the cash, but we haven't earned all of it yet. It's a liability because they will still owe the customer the service for the duration of the subscription. Each month, as the company provides the software service, it gets to claim a bit of that prepaid cash as earned revenue. This continues until the year is up, and all the prepaid money is fully accounted for as earned revenue. While this is happening, the cash from the advance payment is already sitting in the company's bank account. This boosts their cash position, allowing them to use it for day-to-day operations or other investments. But they have to remember, although they have the cash now, they need to provide the full service promise to the customer to fully earn it. I hope you can now see how liabilities are not just financial obligations. They are strategic tools that enable businesses to harness opportunities and drive growth. Effective management of liabilities ensures that they serve the business goals and enhance its financial health. If you found this video useful, give it a like, share it, leave a comment, and subscribe if you haven't already. Thank you for watching. See you next time.